All right. Hello, everybody, and welcome to another live stream here for Pepperstone. Today, we're covering mastering technical analysis. So, we're covering a broad range of topics, and I'm really looking forward to going through those. In particular, really answering some of your questions with some live charts as well. And that I think will be really interesting. As always, if you have questions throughout today's session, feel free to ask them in the chat. I will always encourage that, and we believe that there's going to be quite a lot of value. We're going to be covering some in-depth knowledge of practical skills that we can use in these markets. At the moment, we'll be covering a wide range of technical analysis techniques, including some chart pattern analysis, and then bring it together with candlesticks and some of the tips and tricks, and more importantly, some of the secrets that people sometimes forget when it comes to trading. Making better informed decisions is always super important. And more importantly, it's also really important to be patient and then, of course, hopefully react and not predict. So, how's everyone out there going? I hope you're doing really, really well. If you're watching this in the after, put a comments down below as well, and make sure to smash that like button. It does help Pepperstone know that you enjoy this type of content. So, let's get into what it is all about. And just before we do that and we recognize price action trends, we've got a quick disclaimer that we need to play. So, we'll be back in only a few seconds. All right, well, let's give a shout out to people that are joining us here early. We've got Roman, White Knight Vlogs, Chandrashka, I think, Ramil, Wollongabba, Joshua, and many, many others joining us. So thank you very much for getting involved in the chat. So let's begin by recognizing trends and price action. So I think probably everyone's familiar with uptrends and downtrends, and this is an intermediate session, so we have to expect that you have some basic knowledge of peaks and troughs. In essence, let's run over it really quickly. Effectively, what happens with markets is they usually have this kind of pure technical idea and theory where you get kind of like 2 steps forward, 1 step back, 2 steps forward. And what effectively is happening is you've got what we call first time frame kind of trends, and they are going up and then they reverse and then they go up again. And this creates what we call a second time frame change of trend, or as we have in one of our courses, it's called the lightning bolt. Now, what this is in this essence is it's a trough, it's a peak, which is of course that first move. So first move up, impulse move here. Then we get a pullback, and then we get a higher trough in this case. And once we break through this peak up here, we can kind of say, well, we're probably in an upward trend. And in essence, that is very, very true. And for a swing trader, that's predominantly what they're looking at when it comes to price action. If you load up a 5-minute chart, a 15-minute chart, a 1-hour chart, a daily chart, a 4-hour, most people will define trends kind of like this. But of course, there are a little bit of secrets behind how we can recognize price action a little bit more effectively. So let's have a look at what that could be in just a moment. But I also want to talk about another way that trends can start, which is, of course, out of a channeling market. Now, contrary to popular belief, markets tend to remain relatively range bound for a large period of the year. In fact, at the moment, we're getting what we call a lot of momentum style trades, and momentum strategies are doing very well in the indices, such as the S&P 500, NASDAQ, and of course, also currencies such as the US dollar. But what doesn't usually happen is that won't hold up all of the year. Somebody in the chat might know the stats, but in general, it's around 7-ish to 8-ish months of the year. We tend to be more in a range bounding market. And the other 3 to 4 months, we tend to be more in a trending market. So it's important to have 2 strategies that you can effectively use. And learning patterns is also the basis of a lot of this foundation. So we haven't talked about it in a while, and I thought it would be worthwhile bringing back up, and that is the essence of basic. So again, we do expect that most of you probably already know a little bit about this, but of course, support is in essence when a market comes down and it is bought up. Effectively, what happens is someone steps in. When you're looking at a chart, a little bit of a top tip, start to think of it more as a storyline than just a pattern or just a candlestick or just a setup. Think of it as, what is the story of the market trying to tell you? I can say that this was a big change for me when this happened in terms of being able to put together a more, I guess you could say, congruent, but more systematic approach. And I noticed here, Wollongabba says you need to have a systematic approach. Yes, trading is a business, so we must be system experts, and therefore we have to have our system. So the market initially comes down in this particular area, and somebody decides to step in and buy it up. Now, oftentimes on charts, what that might be represented by is a wick. If it is represented by a wick, what does that tell us about price action? Well, a little bit of an advanced technique is wicks actually show often excitement in the market. Someone has been so keen to buy that they effectively step in and they just buy all of the quantity that's available in the market, and price quickly moves away from that level. If there are wicks at this level, it shows that that zone is probably in higher demand. And if we continue to see wicks coming off that zone in the future, it can actually signal to us that the storyline is getting very good for that level to be so key. Also, if we have a lot of wicks on the level of support, which in this case is, let's just say, the price of 80 cents, and it's the Australian US dollar, let's just claim, okay? Not that it's trading at that at the moment, but just for the essence of today's video. What that is really going to be showing us is that we're saying that this is a very strong level because the wicks are showing excitement. Where are people going to be placing their orders? And we've got a live example that we can look at that just happened a few days ago to really illustrate this point. They're generally going to be placing their stop losses below these lows. So traditionally, retail traders will look at this, they'll see all the wicks and they'll say, look at these levels, we like that. And this opens up what we call a reactionary trade that we'll look at later. And I like to take these reactionary trades. In fact, I believe that some of the most profitable trading in markets is actually thinking about markets from a perspective of reacting to some type of hunt or some type of kind of grab that usually would have gotten you as a trader when you first started. So think back to when you first started trading. Maybe you're just starting now. Where would you place stop losses? Have you sometimes been stopped out? Let us know in the chat. Have you sometimes been stopped out and then the market's gone off in the opposite direction? Let me know now, and we'll give you a shout out in the chat. So of course we have here the support. This is the market. In this case, we have a lot of wicks. Then we have a resistance point. And what happens with the resistance, it's effectively just where people are taking profit. And that's the storyline. People are taking profit, they're closing orders, and sellers are regaining control, and they're effectively pressuring the market down. And sometimes the market will sit in this range for a while, and then eventually it will break out either to the upside or the downside. And it's what we call a channeling market. In essence, they pretty much are points where market has found what we call equilibrium, and it's trading within a fair range. And when we get a breakout from these levels, what we're actually doing is we're looking for the next level of equilibrium. Where is the market going to next? That's something that we always ask ourselves the questions, and it's very important to think about. So traditionally, when a market breaks out to the upside here, people will buy it. This is a channel pattern. And what you'll traditionally see in books is that you take the distance, which is A. So that distance here between the high and the low is A, and that distance will then theoretically be where the market should go to. Now, that, of course, is great in theory. The problem is it the reality? Remember, we said before, talk about the storyline in the markets. And this is something that really is a big component of mastering price action. Where does the market go to next? Well, often we can find hints by looking at the left-hand side. Now, if a market had come down and had done this, and then it had gone into this level and consolidated, so let's say that's zoomed up, it would be fair to state that probably the market is returning from A to B. Therefore, it becomes a self-fulfilling prophecy. But if there was very little structure on the left-hand side, and in fact, the last period of time that we saw consolidation or equilibrium was up here, there's a higher chance that this breakout will actually go more to this area due to the fact that it's going to the next level of what we call equilibrium, the next level of structure. If you're unsure of what we're talking about here, I would suggest that you maybe go back to some of the other Pepperstone library videos that we've done on supply and demand. And that will probably get you a little bit up to speed with what we're talking about when it comes to equilibrium and fair price transactions. So let's consider that this is what most people would do. They would place their stop losses below the low. They would look for the distance, and that's where they would generally do it. This is standard pattern trading. There is also another standard type of technique within support and resistance, which is, of course, what we call role reversal. And actually, it's one of my favorite swing techniques because it's quite basic to understand and it makes a lot of sense. What markets tend to do is they will break out of a zone, e.g., the resistance. And then as they break out, they will sometimes come back and allow people to pick up positions. And what I want you to do here is an extremely good technique that you can get a little bit more like value out of is to think of the market is actually the resistance is kind of this entire box. And what that means is instead of just having a static line, we're saying, well, orders were placed through this position, through this area here. Those orders led to a huge rally. If the market comes back down, it's likely there are buyers that are going to be supporting it through here. And that, in essence, is what we call supply and demand. In this case, this would be demand, and this would therefore be demand again in the future. But if we think of role reversal, what the market's doing is it's basically coming back to get fair value. It's coming back to get that structural zone. So this is something that we want to be thinking about in markets. And again, we'll look at some opportunities in the live markets in just a moment where we'll apply some of this practical theory. The next one is we look at chart patterns. Now, most people are familiar with these types of chart patterns. Does anybody in the community here have a favorite chart pattern that they like? Let me know which one you think is the best, and then I'll tell you which I think is the best. So is there any particular chart pattern that you guys like? Is it a double bottom? Is it ascending triangle? Is it inverse head and shoulders, flags, cups, all sorts of things? There's plenty of different patterns out there. Pennants, let me know in the chat. For me, it has to be, I would say, probably the inverse head and shoulders, followed quickly by probably something like a double bottom or double top. But there are specific little things that I look for in these patterns. I do love pattern trading. It was one of my first things that I started to do in markets, and I thought it was really awesome. And of course, it is because you are given quite a few different rules. In traditional patterns, you're usually given a stop loss, a take profit, and of course, an entry criteria. In this case, the entry criteria would be the breakout of these levels here, the breakout of the neckline in the inverse head and shoulders, the breakout of the flag pattern. Quick tip with flags, by the way, if they go too far down, just think, would that flag be able to fly if you put it in your backyard? And if the answer is it wouldn't fly because the flag was too long and it wouldn't be able to fly in the wind, it's probably not a very good flag, yeah? Usually a 38.2 fib is a really good level for that. So we have our take profit, our stop loss, and of course our entry criteria. Then what we do is we break down, well, what does that mean? Well, with a double bottom, it would be the distance from the low to the neckline. That would be A, that would equal B. Traditionally, that's what you would look at. For an inverse head and shoulders, some people's favorite pattern, it's the distance from the head to the neckline. That would be A, that becomes the distance that you want. My suggestion is when you're doing this, whether you're on a 5-minute, 15-minute, 20-minute, hour, 2-hour, 4-hour daily, whatever time frame, would be also to have a look at the left-hand side. Start thinking outside the box. When it comes to mastering price action trading or technical analysis in general, you've got to say, okay, yes, this is what the books say. But when you go to university, when you do any type of education, the world of difference between the theory in the books and the real world is totally different. I'm sure we've all been there. I remember when I came out and went to my job and I was thinking, is this, I've learned all this stuff. And then they're like, don't worry about that. This is the real world now. It's time for you to relearn this. And pretty much that was the way it went. The theory was a little bit different from reality. It's the kind of same way here. We've got these nice distances, which is excellent. But what we also want to be doing is looking at the left-hand side and understanding whether there's a potential role reversal there, whether there's a potential, again, supply that could be hit, et cetera, et cetera. So it looks like a few people here say that they like bull flags and bear flags. Fair enough. Spot price says head and shoulders. TT Paul says flag. Braden says big old double bottom. Absolutely. All the triple, he says, all the triple. And then 360 building and pest inspection says ascending triangle. So everyone seems to have a very different pattern that they like. So I can understand why, every one of these is good, because let's say we have a flag. The benefit of a flag is you can make the distance of the pole. Sometimes flags can pay 3 to 1, 5 to 1, or even up to 10 to 1 ratio. The problem with a flag, and it used to be my favorite pattern, is often it will break out and then reverse on you very quickly and become kind of like a double top almost, or a double bottom, and it will all be part of a trap. So you got to be very, very careful there. The problem with an ascending triangle is that actually ascending triangles or descending triangles can be traded both ways. If an ascending triangle fails at this point, actually the trade to the short is very good as well. Now, have you found that 360 building? I assume you would have if you traded enough triangles. You'll notice that the opposite trade, if it does go off, both sides can be very, very handy. So let's actually look at the market and take an example of a double bottom that happened just recently. And I think everyone's going to be able to see it straight away. And this has a couple of tips in it. This mastering price action analysis or technical analysis in general. It's about understanding what are the tips here. So the first thing with the dollar index is it comes down to a point. Now, if we scroll out to the daily, you can kind of see where it stops. It stops within previous structure. So in essence, this is resistance, and that resistance becomes support. Anyone know in the chat what that is? Well, I'll answer it for you before you do type it. I'll give you 5 seconds just to go. So 5, 4, 3, 2, 1. There we go. And yep, it's of course role reversal. So theoretically, we've had a resistance, we've had a breakout, the market's come back to it, and it's acted as support. Now, it's acted as support at the very earliest point it can. It could have acted as support technically throughout all of this, but it acted straight away. So if we're going to predict that, I'm usually not a huge fan, but if the market comes in and then it makes a double bottom on a smaller time frame, such as a 15-minute or a 1 hour or a 5-minute or anything, it could be an opportunity for us to, of course, get involved in a scalp. So if we go down to the 2 hour again, you'll notice the double bottom is present. Can anyone guess what the best thing about this double bottom is? So it comes down like an absolute freight train. Pretty strong. Then we see a market come back up. So of course we get here a low and a high, and then the market comes back down. And this actually comes up with Braden's question here. And he says, patterns can be set up by the big dogs, he calls them, easily. So yeah, the thing with this one is, yeah, absolutely they can. And remember what I said before, one of the ways to master technical analysis is to say, I recognize this is a key level. Confluence number 1, role reversal, clear. I'm looking for signs that it could reverse. One of those signs could be an inverse head and shoulders. It could be a double bottom. It could be a channeling market. It could be all sorts of different reasons. But then you say, okay, well, if I do see that, do I see something that would have trapped me? Always ask yourself this question. Do I see something that would have trapped me as a beginning trader? And if the answer is yes, then it's quite simple. What do we do next? Well, all we need to do is we need to look for that trap. And in this case, what the trap is that the market takes the low. Remember, you don't have to predict that this has occurred. For a double bottom pattern, generally what you're doing is you're looking for it to break through this area, and then you're marking, of course, A, which should theoretically equal B. Now, the reason I'm using this example is just to prove to you that if we have this and we go A equals B, B, which would be here, is there anything we like on the left-hand side here? Does that make sense for where the market should stop? And the answer is probably no. Woolengabba says divergence as well. Yes, we could add on a MACD indicator. That would certainly be something that we could add on here. And I'm sure there will be divergence. So if we search MT4 MACD, one of my favorite trading view indicators. And by the way, if you are with Pepperstone, of course, you can use TradingView, you can use MetaTrader, you can use so many great platforms out there. So make sure to check it out. TradingView MT4 MACD, it's a great indicator. And you'll see you've got that divergence here. So of course, we have very strong divergence between the two lows. Now, you're always going to have that, but the key is really the fact that it took that low. Then it comes through with a very strong candle. And remember, we talked about the idea of reading into the price action as a storyline. Market comes down, freight train, hits a key level we already knew was important because of the left-hand side. rallies. Okay. We know nothing at this point. Do we have an idea where the market's going? No, I would still claim it's short. The market then comes down, takes the low, and reverses very strongly. Now we can start to say we've got divergence, and you'll have so many divergences. You'll have RSI, you'll have MACD, you'll have all these. Pretty much every divergence is going to show up in this pattern. Then it breaks out, and you can say, well, okay, is it worth my risk reward? Well, if I'm taking A equals B, maybe the answer is no, because it's counter to the current overall trend. But if we look at the left-hand side, what you might notice is there's very little price action stoppage until here. So what would be a great target for us with this? Well, our great target would be this level up here. And what we might notice is that that's where the market comes back to. It comes back to this structure. Now, could it go higher? Absolutely it could. But this is a great level for us to potentially target on this particular time frame, and of course for us to be looking at in these markets. So yeah, I think that's very, very critical that we think about these markets. It took the low, it came down to the level, it created a double bottom, it had MACD divergence. We're already getting 4 separated reasons. The risk reward makes sense to where we think it's going to go to, and we can make that decision pretty much as of this candle here. So we can pretty much make that decision as of this candle here. And as it breaks through, we could potentially place our entry criteria. Now, there are ways of refining this even more, but the point to this is that you can, whoop, my mic almost fell over, guys. That wouldn't be good. That would not have been good. 1 second, I'll just quickly fix that. So yeah, this can be set up in terms of, all these different timeframes here. And you could be on a 5-minute, 1 minute, 15-minute, doesn't really matter. It's the same criteria. Multiple confluence reasons. The way to master technical analysis is never to use one reason alone. And generally speaking, when you see one type of divergence, being MACD divergence or RSI divergence, you're generally going to be seeing quite a few of them. So I would suggest that if you use a lot of indicators, because a lot of people set up and they'll have 4 to 5 or 6 or 7 even indicators on their charts, a lot of the time, most of those indicators are actually going to give you very similar signals at the same points, especially with pattern creation. So this is just an example here, but there are plenty of patterns going on at all times. Let's see if anyone in the chat can spot a pattern that's occurred recently on dollar index here on this platform. So when we have a look here and we're checking out the dollar index futures, what could we be seeing in terms of a pattern that may have formed there? And I'll find you a time frame that might look more clear on. Maybe an hour might look more clear to you guys. And I'll remove this line so we can see it. Can anyone guess a pattern that has appeared there just recently? I'll read some of these questions here. Spot price says risk reward is important. Absolutely. Blake Callan says the wicks are important. Yes, the wick below Blake was very important in that aspect. And then the wick and then the retest, Braden, correct. Divergence, yes. And double bottoms on a larger time frame means definitely an uptrend and vice versa. Yeah, I mean, again, nothing is definite. It is all statistics. I talk a lot about getting the reps in. And what a rep is effectively it's telling us that we are looking at a market that really, we are looking at market from a perspective of replication, systematic approaches. I want you to start to think about, if possible, in your trading system, I don't care what it is, can you get 40 reps in? You go to the gym, you got to do the reps. And then you'll do, more reps and more reps and more reps. And if, depending on what your workout is, you might do little reps and harder weights or bigger weights or whatever. What you're doing in the trading system is you want to get around 40 reps. So 40 of the same systematic style trade. Once you've got that, it's pretty much proven from a human psychology standpoint that you'll have a fair idea of whether your system works. And also you'll have a fair idea of whether your system is replicatable. And therefore you can continuously do it. And what that will mean is that you have confidence. You can do this in Excel spreadsheet or numbers or whatever. It doesn't really matter. You just want to take a snapshot of it and take very similar trades. And the 40 reps are going to give you the confidence to continuously do the same thing on repeat in the future. So we got a couple of people that definitely answered this correct. Congratulations to Spot, Braden, and Dean. It is a head and shoulders theoretically. And you'll notice that we have that left shoulder And then, of course, we have the head, and then we have the right shoulder. Now, it broke through and it's on its way. So what type of distance would we be using traditionally? And again, with pattern analysis, I would rather, when doing the analysis, find other reasons to be in the trade other than just the pattern itself. Now, in this case, it's predicting that we're getting down to around this level, which makes more sense to the chart. The chart is obviously saying that that is a support zone. We saw it buy off there before. So therefore, it makes sense that this might be an area where the dollar index will weaken to. And that's just an example of a pattern that's happening right now. It's not an endorsement to do anything with that pattern. It's already underway, but it's just a pattern that's happening at an interesting zone on the left-hand side. So you've got left-hand side interest, one reason. Head and shoulders, two reasons. Do we have other reasons? Once you've done your analysis, if you get into around the 4 or 5 separated reasons, usually that's a pretty good reason to potentially place a trade. And more importantly, you're looking, generally speaking, I think, at reactionary style trades. So think back to the question we asked ourselves before. Where would you have your stop losses if you were a beginner? Can anyone answer that to me in the chat? Where would you have your stop losses traditionally at these points? Wollongabba says, turn systems into maths to test and validate. Yep, that's fair enough. I mean, look, you're only lying to yourself sometimes when you haven't set up correctly when it comes to these charts. And once you start to think about technical analysis from a storyline perspective, you're going to start to see a lot of things come through. And you're going to start to think, yeah, maybe I should be more patient. Maybe I should react to the market. Maybe I should wait for things to come to me. You won't get as many trades, but if you are patient, you'll find that when the market has trapped a zone, you'll be more sure of where it's going next. So, traditionally, if we think about where a stop loss might be, a person's stop loss could be above here, around 101.25 in this case. The market quickly takes 101.25 and rejects twice and then gives us a head and shoulders. Is that therefore a stronger head and shoulders towards the short? I would answer probably yes, because it has squeezed people into potentially buys that are placed buys above here. It has taken people's stop losses, which end up being liquidity. Because you think about a big trader, big bank, what are they trying to do? They're trying to make money, but they're also trying to set their positions. To set a position, they require liquidity. Liquidity is transactions. For every buyer, there has to be a seller. For every seller, there has to be a buyer. So you are looking for those types of things in the market. Wollongabba says win rate is king. Win rate is important, but obviously more than win rate is king, I would say the most important thing is ratio rate is king. So if you won every 2 trades and then you lost 3, you might think, well, that's pretty bad. But if you're taking a 3-to-1 ratio, that is, you risk $100, you make $300, that's pretty good. So I would say that it's all about ratio. Win rate is great for your psychology, but more importantly, it's also about ratio. And I think the thing with win rate and ratio is you don't want to have too many 11-to-1, 20-to-1 systems where you're a win, you get 20-to-1, loss, win. While that may still be profitable, the hit that it's going to take to your psychology is going to be massive. So I think that's something that, it's always important to note in these trading environments. All right. So that's just an example I saw there on the dollar index. Let's grab it back into the slides and take a look at some other examples here of what we need to be thinking for when it comes to mastering technical analysis. So, of course, we talked about the role reversal before. We actually saw it literally appear just then, where basically we had a previous resistance, we broke out, we came back to it much later on, and we found a double bottom. That double bottom led into the previous supply or the previous resistance zone, and then we've seen a little head and shoulders. Okay, cool. An example for right now, but that's role reversal in a nutshell. In terms of don't FOMO, this is a big thing. Having patience in market is big. We've all felt most of these emotions before as traders. Euphoria, definitely felt that. Anxiety, denial, fear, desperation. not a good period. Panic, very bad. And then, of course, despondency and all of these things. In general, where do we want to be as a trader and investor? Well, unfortunately, we want to be right in the middle. Now, that doesn't mean desperation. That basically just means that we want to be neutral. If you look at every great investor out there, whether it's Warren Buffett, Stanley Druckenmiller, Ray Dalio, any of these guys, what in general, during their prime, during their best periods in the market, what they're looking for is being very strong mentally and therefore having a great temperament. And if I was to say what is the most common thing that I find most people fail at with trading, it's having a very strong temperament, like being effectively neutral in markets and not having too much opinion and therefore allowing them to trade what they see. How do you overcome that? Get the reps in. The reps are key to being able to really replicate a great, ability for you to really be better in markets. William Gabba says low win rate favor long loss streaks. Yeah, that's right. So that's right. You end up getting long loss streaks, which can be bad. John says, what if you win 99 and blow the account with one trade? Well, again, why would you lose? Why would you blow an account with one trade, John? The only reason you would do that is if you were taking too much risk. So win and then, loss in terms of ratio is important. So remember we said 3-1. What that means is that you will only lose one portion, being $100 in this case is our example, and you would make 3. There is no capability of you losing more than $100 because that's all you're willing to risk. You place it based on the position that you set into the market. This is the key thing to really trading. You've got to control your risk. Every big fund manager will always look at things like Sharpe ratio. If you don't know what that is, look it up. Sharpe ratio is a great one to look up. And that will really help you to understand that you've got to really have a systematic business-like approach to this. You're not going to open a cafe and order 10,000 avocados if you only have 200 orders of avocados every week. That will send you bankrupt. No one's going to buy your avocados and you'll throw them out or just give them away in the street. So that would be bad. In the same thing in trading, we want to take it very seriously. It's your money at risk. You've worked hard for it. You have to protect it. How do you protect it? Well, yes, a big bank's probably not going to have a stop loss. They're going to descale and scale up a position. But what you should do is you should have a risk protection system in place. And of course, that's why people like pattern trading so much, because again, you have an inverse head and shoulders. You put the stop loss underneath, in this case, the right-hand shoulder traditionally. And then of course, the market would ideally go up to the next level. Some other questions coming in here says, when I want to trade the 1 minute with multiple timeframes, I try to trade at the 30-minute level. Fair enough. So you're going top down. Yep. 3 or 4 timeframe kind of segments up is good. Wait for the break and retest, but I seem to always not do very well. I think the key there is probably that the 30-minute time frame is still a little bit short. So you want to be looking more at initially daily, even though I know you're trading a 1 minute time frame and it might sound, why would I look at the daily? It's very important you mark out your day high, day low, and you think about where the market's at during your time of trade. Are you trading opens? Are you trading afternoon sessions, which are going to matter less? Are you trading the cross between London into New York? If you're trading open sessions, often markets will go off in one direction and then reverse, and that will happen around day highs and lows. We've talked about this a little bit. It is in a course that we run, which is called the Day Trading Masterclass, which I'd highly suggest if you like this type of stuff, you might look at because it's pretty good over at fxevolution.com. But you've got day highs and, of course, you've got day lows. And you want to map both of those. And if markets take either the high or the low during certain times of the day, especially around opens, and then reverse, that could be a pretty good signal that it is trapped some liquidity, it's grabbed a position, and then it's off into the opposite direction. So remember we said before that we would swing back into the lightning bolt concept, which is, of course, this type of thing. So, whoops, 1 second. Why did I draw it like that? This type of thing, or this type of thing here, the lightning bolt, the traditional price action sequence, the trough, the peak, the higher trough, and the higher peak, or the low, the high, the higher low and the higher high. This is usually what most people talk about. What I'm interested in you thinking about a little bit more is that when you approach markets in the next period of time, have a look whether it is actually better to look at the left hand side and consider that if a lightning bolt is occurring, such as this, has it taken the previous peak or the previous highs out? Okay. Or the previous lows if it's a change to the downtrend. This is very, very important. If that has happened, what in essence you've done as well is you've taken out what we call a supply or a demand zone. That's another price action technique, supply and demand. So if you are taking out a supply and a demand zone, you are also using the standard kind of support resistance concept of change of trend. You're doing two things at once, therefore you have more traders in your favor. Also, if you think about it, if you took out a previous high or a previous low, what are you doing? Something significant has taken that out because these are what we would call defended zones from the markets, such as the big banks. These are zones where they are most likely going to enter more positions if the trend was truly down and they would enter more shorts. Once that level has been taken, there's a good chance that pullbacks will be met by buy demand. And that's only the beginning of a sequence, but at least that's a sequence that you can then apply to a whole bunch of your other concepts, and especially on those smaller timeframes. So I think we got a question before that said that you fail at 30-minute and 1-minute charts. Maybe consider looking at this on the charts, and I think you might find that there is a little bit of merit to this. Wollongabba says systematic reduces emotion, correct. And John says just a comment on how important the win-loss ratio is. Absolutely it is. And yeah, so we got a few other questions coming here, but I'm trying to get a move of the day like 0.4 pips on the GU. So I think what you mean is probably 40 pips on the pound USD. So I understand you're trying to trade that time frame and you're looking at these higher and lower points, but what you're wanting to see is you're wanting to see something that has probably trapped price, and therefore it's willing to go to the next zone. So it's willing to not only be fast so that you can be in and out fairly quickly, but on top of that, you're also looking for some kind of consistency. So say like an example here, if we look at the pound US dollar, which you're trying to, trade, at the moment, the pound US dollar has broken the high on the daily. Now, you would not necessarily know that if you were only trading a 5-minute chart. So I would suggest you might mark the day high, because what that can often do is the day high and the day low will hold a certain level of momentum. So if the market breaks through, doesn't reverse, and the market's breaking through, you could have a strategy that was already starting to go long. It breaks the high, and then it holds above that high on some significant timeframes. There's a good chance there'll be more momentum through that. Put yourself in the shoes of a bigger investor. Do you really think they're trading a 1-minute time frame with you? Algorithms do. Some people do trade those timeframes, but predominantly it is flow that's coming from the bigger timeframes down. So you have to always know where your day high lows are. You have to know where your key levels of roll reversal are. And it is important even for your 1-minute chart, even for your 5-minute chart. And a lot of people make this mistake. Believe me, I've done it. I started on tick charts and 1 minutes and went up to 1 hour, went up to 4 hours, went up to 1 days. It doesn't mean I don't trade 1-minute, 3-minute charts. I can trade them, but at the same time, I will still break down from the top down. And for anyone that's followed us for a while here and followed these Pepperstone live events, you would know that this is something that we do. Can you explain average daily ranges? So what do you mean, the indicator, or what would you like to know about it? So if you look at an ADR indicator, is that what you're looking? I assume it's something like that you'd like. Probably not really what we're covering in today's session, but we will do some stuff on some indicators very, very soon, including those indicators. So that'll be pretty good, Nolan. Imtiaz says, I place one order at a time. Sometimes the trade goes against me, even though I'm sure it will be a win. It has been. Is it a good idea to open a second trade if you are confident and not risk it. So I place an order. I place one order at a time. Sometimes the trade goes against me, even though I'm sure it will be a win. So he's thinking it's going to be a win. Is it a good idea to open a second trade if you're confident or not risk it? So yeah, I think the thing there with placing extra trades is generally you want to reward a trade. So let's say you positioned, for lack of a better example, we'll go back over to the dollar index and we'll come back over here because it's a great question. And we go back down to the dollar index and you can see here we've got lows and we get a breakout. Let's say you bought here for whatever reason. Your system said buy. As the market breaks through here, you get confirmation you're probably correct. Therefore, the odds of your trade going to the target have just increased. Could you add or scale into that position? Yes, you could buy a little bit. Yeah. So you could buy a little bit extra. Maybe you could scale in a certain amount. Maybe that scale is a third of your order, a half of your order extra, or even a quarter or an eighth or whatever it is. So you generally want to buy as you're making money. Most people, they make the mistake of doubling down when they're losing money. And for lack of a better way of thinking about it, this is the problem that most people have when it comes to casinos, and they know this. And what it is generally is that when you're winning, most people won't double and triple and quadruple. When you're losing, people can tend to go actually bigger bets. And they tend to double it, triple it, quad it, do all these things. You should never do that. Remember, when you're on a streak, you're doing a lot better. There's a book by a guy called Van Tharp, and it was, basically a psychology book. And I don't think Van Tharp's alive anymore. But what he did was he just basically flipped a coin and he bought and sold the market. And instead of, when he was getting basically lucky, what he would do, because he was flipping the coin, is he would ramp the market. He called it market's money. Basically, sometimes he'd go on statistically, big runs, maybe 10 wins in a row, 15 wins in a row. And as he was going up, he would take a little position of the previous position, so a bit of the profit, and he would scale up the order. And what that allowed him to do was it allowed him to compound when he was winning. And as soon as he took a loss, he went back to the normal standard risk again. And he actually found that by doing that, he was profitable over the longer term. Now, that just shows you the power of that type of thing there. William Gabba says, martingale is great till it isn't. Yeah, that's, of course, where you double, 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 and you keep doing it until it gets, out of control. So there's quite a few good questions coming through here. But in essence, what I wanted to get through today is that the patterns and mastering technical analysis is about understanding, in my belief, multiple different styles of technical analysis. Whether you're an Elliott wave trader or somebody that likes support and resistance and therefore usually likes patterns, or somebody that likes Wyckoff, or somebody that likes supply and demand theories, which is pretty much the beginnings of Wyckoff anyway. If you like these types of concepts, why not learn a bit about all of them? And when you build a confluence of multiple techniques, such as multiple indicators and things like that, you don't have to necessarily use them all over the period of time. But remember, support, resistance, supply, demand, in essence, are very similar concepts. Yes, they're slightly different. If I had to pick one, I'd probably say supply, demand is much better for day traders and scalpers. And we'll talk about that in the future in a video. And support and resistance is probably better, pretty good for swing traders to get levels. And pattern trading is just excellent for finding traps and therefore being reactionary. And that's kind of like a bit of an essence of some of the things that I think we've covered here today. As always, I want to say a big thank you for coming out and joining us. If we have a look here at some of the markets that are going on right now, we'll just have a look at the euro US dollar here on the Pepperstone platform. And we'll take a look at whether there's anything interesting here that's setting up. So first up, we'll go over to a daily. So you'll notice the previous day ended as a long leg doji. So the first thing I would do when I came into this chart is I'd ask myself the question, where is this long leg doji? Here is a previous resistance. These are the closes, and it's becoming support. So technically it's at role reversal. It's possible that the euro will go long here. It's possible. This is a long leg doji. Therefore, it tells us that we are at an indecision period. We're effectively finding equilibrium in the markets. It's fair to say whether the markets are going bearish or bullish, it may sit here for a period of time and coil before making the next decision. We can also see that there was a long leg doji or little doji up here as well between that day high low that we've got marked. And when we now scroll down to the 2 hour, I would guess there's some structure in there based on the doji. There it is. There's the structure. Therefore, we know where our supply is. We already know that the markets have rejected that once. So if the markets came back into this structure, I could see that bears could be placing positions here. Therefore, as a day trader, I might come in and look for the potential of shorts in this zone. Again, not an endorsement to do so. It's just the way I think about these markets. What else could we be looking at? Well, if a market breached through this little high, it probably is going into this structural zone. If a market takes this high area here and then does this, that's probably a head and shoulders that I might want to potentially place a trade on because it's taken people's stop losses that are above here. See how we're starting to build some ideas, some chess concepts? And I don't know which one's going to be the way it is, but I'm going to be looking for that storyline and setting those alerts. So if I was looking at a chart like this, I'd probably set an alert in the middle here. And I would look at how the market prices into that level. And I'd also set an alert for today's high. And I'd set an alert for today's low. And then basically I just come back if one of those zones happened and then reanalyze to see whether there's some form of edge on those particular timeframes. And I'd always start at something like a weekly, daily, break down to the 2 hour, break down to the 1 hour, break down to the 15-minute, 5-minute, and then just keep looking and keep analyzing these markets. There are lots of different currencies, of course, you can choose. A few people are mentioning the US dollar yen at the moment. We go and have a look at the US dollar yen. This does have some central bank policy stuff going on, but it's a very similar process. We're looking at it. We're saying, okay, where are we right now? Is this an important zone? Very hard for me to tell on the daily because, of course, 142 is more probably a fib, which we've covered before on the channel. And then we go over here and we can say, oh, okay, well, it's been rejecting and coming back down. Do we have edge? Is there something that's replicatable here? So that's a question that we often get asked, or we're looking at, in our own analysis. I think you're at a small point of role reversal, resistance becoming support. I wouldn't say that's strong enough to do anything off in particular, but we continue to analyze. We continue to come down through the timeframes and break it from there. All right, everybody. Well, thank you very much for joining us here at the Pepperstone live session. As always, we do these every single week from Wednesdays, I believe, at around 8 p.m. Australian Eastern Standard Time. So whatever time it is locally for you. Make sure to get involved over the next couple of weeks. We've got so many great topics coming. And of course, Tyrone will also be joining me next week as well to go through some of our usual banter and discussion about another topic. Today was more of a Q&A. I will record some of these things as well that I believe Pepperstone will be putting out in the future as little snippets. So you guys will be able to see some of those things, and I'll do that after. And I hope you found some value in today's video. And of course, you've been enjoying what Pepperstone has been bringing on the channel. So thanks so much. Good luck out there. Remember, support resistance, role reversal, patterns, supply demand, bring those things together and you might have a better idea. What is the chart storyline telling you? That's going to be one of the most important things. Thank you so much. Bye for now. Thumbs up that video. Catch ya.